Good morning, teacher. With my classmates Darla Almeida, Sofia Granja, and Maite Sandoval, we are going to present our project based on the Global 2020 simulation. During this presentation, we'll explain the company overview and the initial strategy diagnosis. To begin, it's important to introduce the company used the simulation. Smart One is a company in the textile industry that operates within the Global 2020 simulator. The main objective of the company is to evaluate, plan, deploy, and control information from all business areas in order to support strategy decisions making. Smart One competes in a highly dynamic market where design, price, and brand are key competitive factors. Additionally, the textile industry is constantly influenced by changing fashion trends, new customer habits, and increasing customer expectations. Because of this, efficiency supply chain management becomes essential to control costs, avoid excess inventory, and remain competitive in the market. At the beginning of the simulation, an initial SWOT analysis was conducted to understand company situation. In terms of strength, Smart One benefits from an integrated view of its operation, allowing better coordination between areas such as production, marketing, and logistics. This also provides company and controls tools that support more informed decisions making. Regarding opportunities, the company can take advantage of trend and the textile market, especially by improving efficiency, adjusting production of demand, and strengthening its competitive position through cost control. However, some weaknesses were identified, mainly related to the strong dependence of our current initial planning. Poor decisions could generate inefficiency, high cost, or excess inventory. Finally, the main threats include intense competition with the textile sector and the constant change in consumer preferences, which require the company to be flexible and responsive to the market's conditions.
Now, we will see the value evolution. In 2025, Smart One started in a recovery phase, facing inefficiencies, high costs, and excess inventory. By 2026, efficiency improved, the production was stabilized, and costs were controlled. In 2027, controlled growth came with the investments in design and organizational capabilities. And finally, by 2028, consolidation was achieved with maximum production and better inventory management, with which overall the company value remained negative, but showed a gradual improvement across the 4 periods. Now we can see some graphics given by the platform that we have seen that Smart One showed a steady value growth, though it was a bit more conservative than other companies, which show that it decreased based on the others. Now for the strategic orientation, our general strategy was cost leadership. We offer low prices for ties, t-shirts, and accessories while ensuring operational efficiency. The focus was a long-term sustainability, not the short-term gains. In the strategic summary by period, we can see that each period reflected a clear orientation for efficiency first, consolidation second, and cautious expansion third. Now, for the value proposition, Smart One value proposition is very simple. The first is essential value, and then the smart pricing. We deliver affordable and reliable functional products with the best price value ratio. Our position was clear. The go-to brand for price-sensitive consumers in Spain with the potential expansion in Europe.
Okay, so moving on, we have the objectives and the initial action lines. So, as at the start of the simulation during the competition, our main objective was to apply a cost leadership strategy. As we already said, we focus on the economy segment, offering low prices and controlling cost. As you can see, here are the initial action lines for each period. So, our initial actions were to reduce losses, improve efficiency, and avoid financial risk. We decided not to take loans and to keep investment control. Spain was our main market in the first periods, while we worked on stabilizing operations and improving maintenance and organization. Now, then we have the KPI evolution. So the main indicators we take into account was sales, profitability, operational efficiency, and market presence. So in the first periods, sales were high, but profitability was negative due to high production and excess inventory. In later periods, as you can see, we increased maintenance, adjust production to demand, and improve efficiency. Losses were reduced and operations became more stable. And then we have the general strategic overview. As we can see, the core markets were always Spain as the main market, and then Central Europe, take into account with an under a control expansion strategy. Finally, we have the operational focus, we have the efficiency, cost control, as well the demand-based production, and it's very important to take into account that no factory was opened or closed during the game. Then we have the period one, the setup that the platform gave to us. We have the main data. As well, we have the initial decisions for 2025. Then moving on, we have the operational adjustment we did for 2026. Then we have the control expansion for 2027. And finally, we have the final consolidation for 2028.
So the analysis of partial and total results. First, we analyzed partial results by stages. In the initial stage, very high production and low maintenance generated excess inventory and negative results. In the intermediate stage, increasing maintenance and adjusting production improved efficiency, but opening Central Europe without promotion limited its impact. Finally, in 2028, production was aligned with demand and operations became more stable, although performance remained behind more aggressive competitors. From a financial perspective, revenues remain relatively stable at around 2.4 million, but profitable stayed negative. The net result at minus 371K, mainly due to high financial and depreciation cost, despite a stable manufacturing cost. On the balance sheet side, total assets increased, driven by inventory and fixed assets. However, debt increased significantly to 1.39 million, reducing financial flexibility and impacting equity. Operationally, efficiency improved significantly, reaching 10 out of 10, and factory utilization increased to almost 90%. However, market share declined to 9.9, showing limited differentiation. Overall, Smart One finished in the fourth place with revenues of 2.4 million, clearly below the market leader. Despite high efficiency, profitability remained negative, which explains the final ranking. These results reflect a constant cost leadership strategy focused on stability and cost control, but with limited aggressive growth. So, the lessons learned is that our main strengths were operational efficiency and consistent strategy. However, prices were not revised and Central Europe lacked promotion, which limited our growth. In conclusion, Smart One achieved operational stability but limited competitive positioning. Going forward, we would introduce pricing flexibility, supporting new markets with promotion and balanced cost leadership with selective growth. Thank you so much for your attention.